What's up guys, welcome back to Hypergrowth. Ziming here recording today. I'm at mom's beautiful balcony. In this video, we're gonna take a deep dive into the recently IPO'd insurance startup LMND. So if you wanna see in detail how I break down this business and whether at the end I decided to invest, stay tuned. So for those of you who don't know, LMND is an insurance startup primarily aimed at users under 35 who are first-time renters and homeowners, and aim to provide a fundamentally different experience that is fast, simple, and using the word delightful. How do they do that? Basically, if you want to get insured for your renter or homeowner insurance through LMND, you just need to download the app, and it only takes 2 to 3 minutes of chatting in conversation with this AI bot called Maya to get everything set up. You need to file a claim. You basically just chat with another AI bot, Jim, and it takes sometimes only seconds for that payout to come back. Now, as a senior in a university, almost everybody I know either uses LMND or knows someone that uses LMND. Me personally, I've actually been a customer of theirs for almost 2 years now. While having a product that you use yourself and everybody around you love is certainly a good start, it doesn't make it automatically a good investment. So let's look under the hood to see their numbers. Now, in the S1 that LMND releases prior to their IPO, we see that in 2019, they actually reported only $67 million in total revenue. And accompanying that, it is more than $100 million of loss, which is quite shocking to see in any business, frankly, to have a bigger loss than its revenue. However, the positive trend is that from 2018 to 2019, revenue grew almost 3x from 22.5 million to 67 million, while losses only doubled from 50 million to 100 million. So you can actually see the shrinking loss ratio that come with revenue growth and scale. Now, I'm sure that number already scared away all your value investors. But although it's true, the path to profitability or even cash flow break even is extremely unclear. Let me try to make the case for you why it might still be a great investment for the long term. So first of all, I think you have to step back and look at the overall industry. Insurance is a massive industry. It commands over more than $5 trillion worth of premiums globally. That is 11% of US GDP. And even if you look at just US insurance premiums, it accounts to almost 3% of US GDP per year. So there is a tremendous, this is a tremendous total addressable market that is even bigger than, let's say, the commercial real estate market that WeWork was going after, or the ride-sharing market, the taxi market that Uber was attacking. And also, I don't think it takes a genius to see that the insurance industry is one of the most hated, has extremely high cost structure, bureaucracy, lack of innovation, and frankly, a really fat, healthy profit margin for a startup to attack and disrupt. At 20% industry average gross margin, at 6% net profit margin, multiplied by trillions of dollars moving globally, that is easily hundreds of billions of dollars up for attack, where all these legacy companies are just sitting there year over year, thinking that nobody will come and take that away from them. And this is where LMND comes in and creates a fundamentally different experience for its Gen Z and millennial customers around delightful experience and also social value. One of the differentiation that it's unheard of in the industry is their give back feature, where they set a predetermined percentage of the insurance premium that doesn't pay out to the customers to be donated to any charity of the customer's choice as sign up. And when I was signing up, I was able to choose from dozens and dozens of nonprofit that best fit my value and my goals. Although its monetary return as a business decision is hard to quantify, I really believe that it creates long-term trust and loyalty with its customers, as well as changing the incentive incentive structure for insurance fraud, because when you are making a false claim, basically, you're not really hurting a faceless corporation. You're hurting the people that you pick to donate to. And finally, the last key differentiation, besides the mobile-first experience and the social value aspect with Giveback, is that their use of AI and machine learning to potentially detect and predict fraud, as well as the automation of a very manual intensive underwriting process that creates tremendous overhead for the legacy insurance industry. Now, the following is a stat that I was really excited to see. Basically, Lemonade has 2,000 customers per human employee, while the average in the industry is around 150 to 450. The aggressive use of AI and automation, especially at scale, I think could be a tremendous cost saver. And that in the long term can be a huge competitive advantage over the legacy insurance companies who have huge bureaucratic structures that they would not be able to turn around in years. So what are the risks of investing in a company like Lemonade? First, it's so obvious that with 60 million in revenue and 100 million in 2019 losses, that it would take years before this company can achieve, let's say, cash flow break even and have the business be self-funded. Which means that it's almost certain for this company to have to come back to the public market to ask investors to keep funding the growth of the business and further diluting the shareholder. And secondly, this is a huge red flag I discovered when looking into the balance sheet. Even though it has positive asset versus liability, once you account in the preferred convertible stock in their balance sheet, which is 480 million, it actually results in a net negative stockholder equity. So basically, that's what you're buying into currently with Lemonade. Now, let me pause here for a second. If you want to see my full investment thesis in writing, check out the link down below to my Twitter. And if you haven't done so, smash the like button down below for the YouTube algorithm until it turns blue. Thank you. Now, this is where I'm really torn with investing in Lemonade. On the one hand, you have a brand and a product that's beloved by the people, and tremendous room for growth, certainly in this massive industry over the next 2 to 3 decades, I would say. But on the other hand, you have a terrible balance sheet and a horrible, at least in the near term, horrible business model that will require outside funding for years to come before it can grow with the cash flow it generates itself. At the end, what makes me decided to give this company a shot is really the fact that 70% of its current customers are under 35 and 90% of the customers are not even switching from another product. That means that as these really young customers progress through life, as they gain wealth, as they renters eventually acquires homes and cars and pets, there's such a tremendous room for bundling, upsell, and revenue growth within even the same customer. My $27 of revenue can easily grow into 270 or even more. There's really 10 to 20x of revenue growth per customer ahead of them. So as long as Lemonade can keep growing its customer base, as well as building trust and loyalty with the existing customer, this over the long term can really turn out to be a massive, massive company. Look at 2019 revenue, yes, it's only at 60 million, but even if they only remain 100% revenue growth, basically doubling each year for the next 4 years, it will hit $1 billion of revenue by 2024, and $2 billion worth of revenue by 2025. And if you multiply that with let's say a 5 to 10x multiple, which is typical for the tech industry, you're looking at a $20 billion company. Well, at the moment, it's only $3 billion. That kind of return can justify itself if you have the appetite for such a high risk like that. In conclusion, I think my strategy with Lemonade is to slowly build up a position about 2 to 5% of my entire portfolio, just because of the high risk that involves with investing in such an early stage company. You do have to see it like almost investing in a startup. You will have to put in the money and forget about it. Because Lemonade is coming to market at a much earlier stage of their business compared to Uber or Lyft or Airbnb. Also, usually stocks that have just IPO'd drops within the 6 to 12 months right after. So I really hope to see the stock drop in the short term so I can get a better buying opportunity to build a bigger position to hold for the long term. With that said, thank you guys for watching. If you wanted to get into investing but didn't know where to start, please use my link down below to sign up for Cash App. It is literally the easiest way to get into investing in exciting individual companies like Lemonade, Tesla, and Square. And you can invest in as little as $1 increments. So if you want to see more investing videos like this, or if you want to see more content about my Tesla Model Y, please subscribe down below. I will see you in the next one. Peace.